Hello, everybody, and welcome to Financial Fridays with John King. That is me, John King, your host for today's Financial Friday. I'm going to be broadcasting every single Friday at 12 noon, so you might as well join the cool kids and join me every Friday for information about how to improve your finances. I've been doing this now for 21 years that I have been in the mortgage industry, and I've been passionate over that time of really helping my clients understand not just their mortgage, but all of their finances. And it's really important to me to make sure that I am helping to give advice. And that advice might have to do with specifics about mortgages. I pride myself in being an expert in the mortgage industry. But here's the fact. The fact is that the mortgage is really just one step towards building your overall financial house. And it's an important piece of that people have a lot of misunderstandings. People don't realize what it takes to be successful in having a mortgage, and how to use that mortgage and how to use home ownership to build wealth through home ownership. And that's really my focus, is to talk not only about loans and how to help you qualify and how to help you accomplish your goals, but specifically to talk about finances, talk about debts, how to use debt in a good way, how to leverage the home that you have, things that we need to think about like insurance. We're going to talk about insurance. We're going to talk about estate planning a little bit. We're going to talk about a lot of things that are going to help you in growing your knowledge, protecting your home, protecting your wealth. We'll talk about 401ks and best ways to take advantage of that. So, Financial Fridays, it will be up to an hour every single Friday where I'm going to be really helping you understand how to best manage your finances from my perspective and introduce you to some special guests from time to time. So I'm really looking forward to taking you on this journey as we continue to move forward with what I'm now branding as my Financial Fridays every single week at 12 noon. So we're going to dive in today. The first thing I'll say is if you're watching live and you have questions about anything that I'm talking about, feel free to post into comments. So if you're watching on YouTube, I'll be able to see your comments live. If you are watching on Facebook, I'll be able to see your comments live. Otherwise, if you're watching afterwards or if you're on any other platform, I'll be able to see your comments later once we're done. But if you have questions about anything, please comment, and whether I address them live on the broadcast or whether I address them later, I want this to be as interactive as possible and to really help to give you what you need to answer these questions and to be successful. So let's go ahead and get started today. Our topic today is a big one, and it is about mortgage financing for business owners. And I think this is a big topic for people who own a business. They know getting a home loan is super, super challenging and it's super frustrating. First of all, we just came out of a pretty serious downturn with COVID, and it impacted business owners a lot. A lot of industries had to shut down. A lot of business owners had to do whatever they could to keep their employees employed, and often that means paying themselves last. And it's created a lot of challenges for business owners to get home loans. And I really like to focus on financing for business owners this time of year. And the reason why I like to focus on it this time of year is because now is the time when you are preparing your taxes or preparing to prepare your taxes. And you have the ability to extend beyond April 15th if you choose to go on extension. But the key to successfully doing a loan for a business owner comes to how are we documenting your income, and having your taxes done the right way will make a difference for the next 12 months. So right now, if you are a business owner and you have not completed your taxes yet and you're thinking of buying a home in the next 12 months, the first piece of advice that I give you is you need to talk to me and show me your taxes before you file them. Now, I'm going to get into more details on why. We'll talk about a lot of different things today during our time together, but that is the most important thing I'm going to remind you multiple times through this broadcast is if when you go to file your taxes, if you're thinking of buying or refinancing a home in the next year or two, let me look at your taxes first. There's some tips and tricks that I can advise you on. There's some things we can do to play with the numbers a little bit and rearrange how they show on the tax return that would give you significant advantages in qualifying for a mortgage. And once you file your taxes, you can't simply go and amend them. We won't believe that the amended version is in fact true. We think that you amended your taxes to show more profit simply to qualify for a mortgage, and we're going to use your first version of your taxes. So I'm going to go ahead and get started with the meat and potatoes of my presentation. And we're going to have basically going to have a bunch of Q&A type of stuff on the PowerPoint that I'm going to address those questions as we go forward. Don't forget, as the banner says at the bottom, ticker says right there, right over here. Your questions, post them in comments. John will address them. Okay, so have questions, post them in comments. And if you just want to say hi, feel free to say hi. Looking forward to really delivering some really, really good content. By the way, please like and share this. That's super important to help me grow my message to more people. If you are liking the information you're doing, give me a thumbs up. If you really like it, then please share it and comment, because that obviously helps in the social media algorithms for them to say, wow, this guy John King must be pretty good if people are commenting on his stuff. So I would appreciate that very, very much. All right. Why is it harder for me to get a loan than my employees? That's actually a pretty common question I get. And I've got clients who say to me, John, I'm confused. I own the business. I make way more money than my employees do. And yet my employee just bought a $500,000 home and had less problems than you're giving me. And that's a super frustrating reality. And here's why. Because a job, a job, where you work for somebody else, is assumed to be predictable and stable as long as your income is of a consistent nature. For example, if you pay your employee $20 an hour and they work full time 40 hours a week, I know exactly how much money to assume that they're going to make every month going forward to pay their mortgage. If you pay them a $5,000 month salary, I know exactly how much to assume, even if you just hired them a week ago. Unless it's a contract job that has a specific end time, I assume, well, hey, what you're paying them right now typically never goes down. Wages are sticky, and that's kind of interesting in the era we're in right now. In March of 2022, we've got inflation going up a lot. We've got the price of goods, the price of gasoline, in mortgage interest rates, all of it's going up. But the biggest worry from an economist's perspective is actually wages going up. Because once employees start seeing inflation, I know I'm going off on a tangent here, but this is good, so stay with me. Once employees start seeing inflation as an expectation, they start demanding higher wages. That makes sense. It costs more to buy bread, costs more to buy milk, so you're going to want to get paid more money. As a business owner, you're going to feel the compassion that, hey, I need to pay them more because it's going to cost more to live, and you're going to feel the need because they're ultimately going to leave you if you don't increase their pay. So over time, you're going to see it once, if inflation becomes a expectation, employees are going to expect more pay. The problem is pay is sticky. It is very, very difficult to go to your employee and say, hey, I know I gave you a raise from $18 an hour to $21 an hour last year because of inflation, but now inflation's gone. I want to bring you back down to 19 bucks. They're likely to quit. Like, it's just not something that's normally done. So in the lending world, and we get back on task here, in the lending world, we assume if you're paying them $18 an hour, it's not going backwards. If you're paying them $25 an hour, it's not going backwards. So we can predict that to be stable going forward, even if you just hired them yesterday, because wages are sticky. But being a business owner is not. What you're paying, especially, you're building a business, and whatever income you're making today does not guarantee you're going to make it tomorrow. What you've made over the last 3 months does not mean you're going to make that over the next 3 months. And so we have to look at 2 years backwards and say, hey, what does the history look like for you for the last 2 years? And is it reasonable to assume that's going to continue for at least the next 3 years? That's the threshold we have to look at. And it's a lot harder to see that, especially because as a business owner, you have some flexibilities to write things off. You have some flexibilities to pay less in taxes to the IRS so that you don't have to pay those taxes. You're showing less in profit. The problem is a majority of our loans are backed by the federal government. The same federal government that does that you're trying to avoid paying taxes to is kind of saying, well, hey, if you don't want to pay us taxes, that's fine. But that means that I'm not going to help you get a mortgage using our money if you're not willing to pay me taxes on that same money. I'm a bit oversimplifying it, but honestly, that is why it's harder for you to get a loan than your employees. So, John, how do you look at my income? We're looking at the last 2 years, but sometimes we can trim that down to 1 year. And this is where There's a lot of moving parts to this, but the bottom line is, in most circumstances, I'm going to look at your two most recently filed tax returns. Now, it's really, really important that we're strategic about this, because if your 2020 and 2019 taxes were really, really good, but the 2021 isn't looking like it's going to point so good. You had a major expense in 2021, and it's going to make your 2021 taxes not look so good. Then maybe we put you on extension and we don't file those taxes yet. I don't need to see the 2021 taxes until after October 15th. Think about this. Your taxes are due on April 15th, but they're required, once you go on extension, you get a 6-month extension. You're required to have your taxes turned in by October 15th. So if I'm closing on a loan after October 15th of this year, I must have your 2021 taxes. And then the 2 years would become 2020 and 2021. But between now and October 15th, we can choose whether we want, now we can't, if you filed it, I have to use it. But if you haven't filed it, we can choose whether we want to use the 2 years being 2019 and 2020 because you haven't filed 2021, or we want you to file it right away. And then we can use 2020 and 2021. This even becomes more important if you qualify for one of the options where we only use 1 year of tax returns to prove your income. Because now I can choose to use 2020 only if you haven't filed 2021, or we can quickly file 2021, and that's the year I use, which is why it's critical for me to see your tax returns before you file them with the IRS. Because then I can make some adjustments, tell you, hey, you might pay a little bit more in taxes, but you're going to qualify for a whole lot more if you just change this up a little bit. And there's cool tricks like depreciation, where we can depreciate some of your assets, and whatever your depreciation is, we actually get to count as income because that expense wasn't really a check that you wrote. Depreciation is the loss of value of those assets, but it is not actually money that you've written a check for. So depreciation is one of the cool things we can play with when we look at the taxes. So that is, excuse me, that's a basic understanding of what we're looking at for your income. I actually had an interesting conversation with a client yesterday who is self-employed, and he was a little bit frustrated because he said, hey, John, I'm finally ready. I talked to another lender previously, and they said I had to wait until March of 2022 because I got licensed in March of 2020. By the way, guys, if you have questions about anything, please post them in comments. If you're watching live, I will address them during the call, during the broadcast. If you're not watching live, I'll comment on them later. So he says, I'm ready to go. It's March of 2022. And my attorney, as a matter of fact, recommended that I talk to you instead of the other tax guy because he said you're absolutely amazing, super smart attorney, to refer him to me. So as I'm talking to him, he says, hey, I'm about to file my 2021s. I said, okay, fine. But can you show me your 2020 taxes? And he starts asking a little bit about, why? What are you looking for? What can I send you just specific pages? And I'm like, no, I need the whole thing. I need to see the big picture because I think I'm going to need to use 2 years of tax returns. And he goes, well, to be honest, I didn't make any, and I didn't file any taxes in 2020 because I didn't make any profit. I was trying to launch my business, and I didn't have any revenue, and I really didn't have any expenses because I was just doing it on the side while I was doing my other job. So I'm licensed. I got my license 2 years ago, but I didn't file business taxes for 2020. So the problem is, he said, I've been licensed for 2 years. That should be enough. And I said, theoretically, it is enough. But the problem is, we're going to have visibility because I'm required to see 2 years of your tax returns. We're going to see that you had no activity. You had no profit you were generating. You had no revenue you even generated. And so that's kind of like saying, hey, I'm going to college because I registered for college. Well, okay, you registered, but you never showed up. Like you never actually attended any classes. You're not getting any college credits. So, hey, I was in college for 10 years and then I never graduated. Well, did you ever actually sign up for a class or did you just register for the college? And I explained to him, the time that he's actually spent working is what we're looking for. Now he's going to look at amending his tax returns because he said, well, I had a little bit of revenue and a little bit of expenses, but it was basically a wash and it wasn't worth putting it in there. And I said, amend those tax returns because for him, it changed how I looked at his income. even if he tried to be self-employed in 2020 and he failed. The fact is, it was time served, kind of like prison. Being self-employed, yes, I'm saying being self-employed is kind of like being in prison. Maybe not the best analogy, maybe a beautiful analogy, kind of depends on a lot of factors. But the bottom line is, I hope that everybody who out there is paying attention, because nobody's laughing, nobody's giving me a haha in comments. So if you're paying attention, can I get a haha in comments? I thought that was kind of funny, the whole prison analogy. Or you can tell me, John, that's a horrible analogy. Don't ever use it again. The point is that if you are in a position where, in his case, he did the work, but he didn't show it on his taxes, I wasn't going to be able to qualify him. And now we're going to amend those taxes. I said amending doesn't count because I'm not trying to show profit for that year. I'm trying to show time served. I'm trying to show that he was in business. Yes, Penny. Let's give Penny a shout out for this one. Penny says too close to the truth. I agree completely, Penny. That's probably why nobody wanted to laugh, because it hit too close to home. So the point is that you've got to show on your taxes that you did it, even if there was zero profit, because he made really good money in 2021. He made $200,000 in profits in 2021. Well, guess what? If he made zero in 2020 and 200,000 in 2021, then he's making $100,000 a year on average. And as long as the averages are moving up, I can qualify him using the $100,000 a year average. Now, for him, I tried to qualify him using 1 year of tax returns. His credit and asset criteria didn't meet the guidelines to go with 1 year. So the bottom line is I had to use 2 years, but if he amends that 2020 to show at least he tried, then I can average the 2 years together. So what paperwork do I need to review? This is super, super important. So make this much bigger. Here's what we're looking at: 1 to 2 years of your personal tax returns, only federal. I don't need to see states. I just need to see the federal tax returns. I say 1 to 2 years. My recommendation, always send me 2. I suffer from a disease of short-term memory loss. It's been an issue ever since I started in the mortgage industry. I say that obviously tongue in cheek, but the truth is, when I see things I don't want to see, I forget that I saw them. So if you send me 2 years of tax returns and I only wanted to see one, I forget that I ever had the other one. I also need 1 to 2 years of business tax returns. So if you are a partnership, an S corp, or a C corp, I need to see the business tax returns as well. There are some circumstances I can ignore the business taxes, but I'd rather see them and decide I don't need them than to chase them down from you later and wonder if it's going to work or not. So definitely get me all of the tax returns up front. And again, 2 years is always preferred. We want a couple months of business bank statements and a profit and loss statement in some circumstances. Really, this used to apply up until a couple of months ago because of COVID. But now Fannie Mae and Freddie Mac conventional loans have said, you know what, we no longer are worried about the current COVID impacts to a business owner. So I no longer need to see 2 months of business bank statements and a profit and loss statement to prove that you're on track right now. That's huge, guys. That created a major wrinkle in the industry during the last 2 years. Because of COVID, the industry cracked down and said, hey, you might have had a great year in 2019, but it's 2020 and it's COVID time, and we don't know if you're operational, and we don't know if you're making enough profit. And so we're going to require a significantly higher threshold of documentation, a significantly higher amount of paperwork to prove that you're generating the income still today. And that was kind of one of the benefits of being self-employed, to be perfectly honest, is that we never paid attention to what you're doing today. I'm looking at last year or the last 2 years of taxes, and those 2 years could be as far back as a year and a half ago, and that's all I qualify you on. So there's some wins when you're self-employed, because we can choose what time frame we're looking at, and we no longer need to look at a current profit and loss or 2 months of business bank statements to prove the deposits, except on jumbo loans and in some cases other types of loans. So jumbo loans, anything essentially above the conventional limit right now, 647,000 nationally. In different markets, it's got higher thresholds, but jumbo loans still are going to require the pay stubs. The other thing is K1s. So if you are a partnership or an S corp, we need to have your K1s, and pay stubs and W2s. This is something super, super confusing. I'm pretty sure I get to this a little bit later in the slide deck, but I want to point it out right now. And that is that when you're a corporation, S corp or a C corp, you need to pay yourself a pay stub. And I have a lot of business owners that say, John, I bumped my pay. I'm making $5,000 a month now instead of $3,000 a month. And I said, how do you show me? Tell me how. I said, well, I have a paycheck. I pay myself every single month, and I'm paying myself $5,000 a month instead of $3,000 a month I paid last year. Let me tell you how we look at that. How we look at that is we say, okay, your business generates a certain amount of revenue with a certain amount of expenses, and that leaves a certain amount of profit that belongs to you. So let's pretend last year you paid yourself $3,000 a month in income on your W 2. And your business, after paying all of their expenses, had what, $66,000 of, yeah, $64,000 of profit left over. I would say, okay, then in 2021, you had $64,000 of profit left over, plus the $36,000 that you paid yourself in your wages that was part of the expenses. That adds up to $100,000. I deem you as $100,000 a year income earner. Now, this year you raised your salary to $5,000, but that doesn't mean that your revenue went up at all. All it means is of the total 100,000 that you made last year, if nothing else changed, instead of $36,000 being your, and I probably had the wrong math, but you understand my point here. Instead of $36,000 being what you paid yourself in salary last year, you now raised your salary to $60,000. Well, that means instead of $64,000 in profit left over in the business, there's only 40,000 in profit left over because the total was still 100. You cannot just change your salary and say, well, that means my business is going to be $2,000 a month more profitable simply because I've blessed myself with $2,000 a month extra in revenue to me. It doesn't work that way. So what you pay yourself on your pay stub is not material. You could pay yourself $100,000 a year on your pay stub and your business loses 20 grand a year. It means that your business only made $80,000 and you were overpaying yourself. So the amount of money you get on your pay stub and your W-2 is not, it's important. We add that to the profit that you made last year to come together saying, hey, I had this much profit left over. And of the expenses, here's the expenses I paid to myself. Those two together total what your earnings are. You cannot simply separate that and say, but I've given myself a raise of $2,000 a month, therefore I'm making more money. All right, so what am I looking for on the tax returns? Obviously net profit or loss. I'm looking at depreciation and depletion. I get to add that back in. So when you're doing your taxes, if you can add more depreciation or depletion, that is a good thing, because depreciation and depletion reduce your profits, but I get to add that part back in because you did not write a check for depreciation or depletion. Same thing with mileage reimbursements. If you are driving a car for business and you're writing off your automotive expense by the mile, a portion of your mileage expense is considered depreciation. I get to add that back in. Most lenders don't understand how that works, and they don't credit you enough, give you enough credits for the income that you actually have on the tax return. It's a lot of ways, little things that I know really, really well about how to look at tax returns that helps me to deliver a higher approval than most of my peers. Amortization. So that is kind of the same thing as depreciation. So amortization is a good thing. The bigger amortization you can have, the happier I am. Casualty loss, that's a one-time loss, so I get to add that back in. Here's a scary one though. Notes that are payable in less than 1 year. So I want you to think about this for a second. Let's pretend that your business 10 years ago took out a $100,000 line of credit, and it's a 10-year line of credit. So when you finish your taxes last year, there's a line that says notes that are payable in less than 1 year. And your accountant's going to put on there, yep, $100,000 note is due. You've got to pay, you're going to have an expense next year of $100,000 to pay back that loan. Well, if last year's total profits were 150 grand, and if everything stayed the same, which we're going to assume everything stays the same, if everything stayed the same, then you're going to have $150,000 in profit this year minus the $100,000 expense to pay off that note. And so I am going to reduce your expected profitability by the amount of money in that note payable. But here's the thing, most of the time, it isn't really a note you took out 10 years ago that's due. What it is it's a recurring line of credit. If you have a line of credit for your business, most business lines of credit are 1 year in duration. So you took out a $50,000 line of credit. Every year, that line of credit gets renewed, which means every year that line of credit is due to be paid off next year. And we have to just explain what it is. Most lenders look at that line that says notes payable in 1 year and they say, oh, we got to subtract that from your profit. You don't qualify anymore. And they don't explain to you why. That's where the shroud of misunderstanding causes major problems for people who are self employed. And it's why, if you're self employed, you need to come to me because I understand how all of this works. And when I see something like that, I'm going to ask you. Most lenders, the loan officer doesn't even understand how to read your tax returns. They send it to the underwriter. The underwriter runs their calculation, finds this notes payable in 1 year, and says, oh, that lowers your income by $50,000. You no longer qualify. And they simply call up the loan officer and say, hey, they don't qualify. You calculated it wrong. And then you get denied. That is something that I don't let happen. I'm going to make sure we have the right numbers in place at the right time. The next thing is meals and entertainment. Guys, meals and entertainment, you're only allowed to write off half of the expense. So if you have $3,000 in meals and entertainment on your tax return, it means you spent 6,000. I've got to hit you for the other $3,000 that you actually spent because the IRS only lets you write off 50% of meals and entertainment. So if, let's say, you're trying to decrease your expenses, it's one of the tactics we use. The IRS has no problem with you showing less expenses because it means you have more profits. So if you're trying to decrease some expenses to show more profit and to pay more in taxes, a beautiful expense to decrease is meals and entertainment. Because by getting rid of $3,000 of meals and entertainment expenses, you're paying taxes on 3,000 extra, but you're picking up $6,000 in extra income from my view, because that 3,000 you showed on your taxes really was 6,000 you spent. So meals and entertainment is a good place to ignore expenses and to not list them as expenses to maximize the profit you're showing on your tax return. Here's another little trick, distributions. Fannie Mae and Freddie Mac have really cracked down on distributions. And it really goes something like this. If I'm a business owner and my business, this particularly applies to S Corps and C Corps. So I own a corporation. I'm paying myself a pay stub every single month, every single week, and there's retained profit in the company. So the company made $200,000 last year, but I didn't distribute any of it. I left it all in the company. That shows on your K1. Many CPAs don't fill this section out. They don't care because it's not an issue with the IRS. The IRS taxes you on what you made in profit, regardless of whether you left it in the banks, in the company's bank account, or whether you pulled it out and put it in your own bank account. So taking a distribution does not impact your tax liability. But what happens is we look at it, and Fannie Mae and Freddie Mac require us to look at it and say, well, okay, so you have $200,000 that the company earned that you didn't make on your pay stub. And we look on your K1 to figure out, was there a distribution? Did you pull that money out of the company? If the answer is yes, great, no problem. Because obviously you were able to pull that money out of the company and the company kept operating. We're fine with counting your salary plus the 200,000 of profit that was left over. But what happens if you didn't pull it out as a distribution? Then we're going to say, okay, then there should be at least 200,000 left in liquidity in the business. There is a page, it's actually section M as in Mary on your corporate S Corp or C Corp tax return that talks about your balance sheet. It talks about assets, liability, and owner's equity. And the balance sheets will tell us how much money you have at the end of the year in liquid assets compared to how much you have in liabilities. And if you don't have $200,000 sitting in the business at the end of the year, then we're not going to let you count that income towards qualification on a conventional loan. I want you to hear me explain this one more time so you understand. What your tax return is saying to us is, I paid myself $50,000 last year in pay stubs. and the company had $200,000 left over at the end of the year. I didn't pay that $200,000 out to myself. I didn't distribute it, and it's not in the company bank accounts anymore. Where did it go? If you only took out $50,000, that $200,000 didn't get paid to you and it still isn't sitting in the business. How can you expect us to count that as legitimate money you can use to pay your mortgage when that money has literally disappeared? Here's the truth: it didn't disappear. It's still in your business bank account. But most tax preparers don't fill out Section M of the tax return. They don't care how much you have in assets because it doesn't impact your taxes you're paying to the IRS. So they don't waste their time. Unfortunately, it's cutting corners for them. But to them, hey, why bother? It's just gathering more information from you that is unnecessary. But it's a major problem for your mortgage. And that's what I'm trying to get through today is some really important tips on how to maximize your qualification and some ideas of overcoming roadblocks that we run into on a regular basis. So please, if you own an S Corp or a C Corp, pay attention to your distributions. Or if you're not distributing the money, then pay attention to your liquidity, your assets minus your liabilities. And you need to have liquidity equal to or greater than the profit you didn't distribute. All right, I know that was complicated. The good news is this is recorded, so you can rewind and go from about the 20 to the 30-minute mark. I probably spent 10 minutes on that, but it was a worthwhile 10 minutes. And I would encourage you, if you're in this situation, to watch it again. Better yet, I encourage you to call me. Schedule a one-on-one consultation. Let me look at your taxes. And I'm going to say this multiple times. If you are thinking of buying or refinancing a home in the next 2 years as a business owner, we need to talk now. And we need to talk at least once a year as you're doing your taxes, because we've got to strategize on what do things look like today and what do we need to change going forward to help you maximize your qualification when it's time to qualify. Okay, so do I have to review the business tax returns? Usually the answer is yes. Sometimes, if there's something on the business taxes I don't want to see, then there is some loopholes where I can ignore the business tax returns, but it's a case by case situation. So, what I encourage you again is send me everything. Send me the business tax returns. Send me all of it so that I can decide, hey, I can meet one of these loopholes and I can ignore this information. Please don't hold back and say, well, I heard that you don't have to send business taxes. There's often a lot of things that I can use on those business taxes to help you qualify for more. So let me see everything. Treat me like your preacher. Tell me the truth. Show me everything. I want to be able to help you qualify for the most. Guys, don't forget comments right here. I said comments and John will address them. I can't move myself along the ticker properly. Anyway, post your comments. If you're on YouTube or Facebook right now, post your comments. I'll see them and be able to address them while we're talking. If not, if it's after the fact, or if you're on another platform, then feel free to post comments and I'll track you down and get you the information later. Okay, what if I file an extension? Extensions are great, except you still owe the taxes. So here's where you have to be careful. Remember, I said earlier, I'm going to recap this real quick. If we don't want to use your most recent year, so in this case, if we don't want to use 2021's taxes, we can just file an extension and I use 2020 and or 2019. Okay, not or, but either 2020 and 2019 or just 2020, depending upon if I'm using 1 or 2 years. But if you file an extension, I need a copy of the extension. That's easy. It's just a printed piece of paper, but there's a dollar amount calculated on there that says, what do I estimate I owe? Because the IRS lets you extend the filing, it doesn't let you extend payments. So you have to project to the IRS, what do you owe? And you can put zero on there, but then if you really do owe money later, they're going to charge you a penalty because you didn't pay it by April 15th. But more importantly is if you put, hey, I think I owe 5 grand, I've got to prove you paid the 5 grand. And that goes true for all of your taxes. At any point that you're filing your tax return and it says you owe money, even if you just filed it yesterday, for me to use that tax return, I have to prove that 5 grand has been paid. Now, one of the things that I don't have on my slide deck, but I'll bring up is, John, what if I can't pay my taxes? That actually happens pretty often. And what we do is we have your CPA contact the IRS and get you set up on a payment plan. The problem is, depending upon the loan program, I need anywhere from 1 to 3 payments having been paid on the payment plan. And that monthly payment has to be able to fit into your maximum debt to income ratio, because I'm going to count that payments as an obligation, just like your car loan, just like your credit card payments. But here's another side note. A lot of self-employed people have car loans and credit cards that are really business debts. And I can ignore those under two circumstances. But if both these things are true, first of all, you need to have a year's worth of payment history showing you paid for that debt out of your business account. The second thing you have to do is you have to be able to show me on your tax return where that expense shows up. Because you might be paying, $1,000 a month for your car payment, but unless you have a $12,000 expense under automotive expense, you might have paid it out of the business account, but it wasn't subtracted from your business profits. So really, really important to make sure you do that. All right. Can I use bank statements instead of tax returns? How does that help me? Actually, it helps you a lot, but it comes at a cost. What we're dealing with is we're dealing with alternative finance options, and they're amazing, but the interest rates are higher. The fees are going to be higher because we're taking a greater risk, and the down payment requirement is going to be higher. Very, very simply, at a very high level, I can use your personal tax returns for the last 12 months and show all the deposits into your personal account, or I can use your business tax returns for the last 12 months and show all the deposits into your business account. Depending upon the circumstances, I likely will apply a cost of goods and expense ratio, depending upon the nature of your business. So if you're a service industry, hey, I'm a massage therapist and I work out of my house and people come to my house for massages. Great. Then you have pretty low overhead versus I'm a car salesman and I own a car lot. Well, you got high overhead because you got to pay for the cars. So you might bring in $1 million, but 500,000 of that is expenses just buying the cars that you're selling. So the expense ratio will vary depending upon the nature of your industry. But the cool thing is we don't have to use tax returns in that case. So if you have a really, really good CPA, or if you have some unique circumstances that cause your tax returns to not show the income that we want it to show, then we can use bank statements to prove your income. And it's a great way to get you qualified. Just be prepared that we're talking about higher interest rates, higher fees, and higher down payment requirements when we're using bank statements. So you're always going to be better off using tax returns if possible. How about if my spouse works for me in the business? That's great. First of all, the income, as long as if your spouse is a business owner, she works with you and we're co-owners. Well, then really it's no different than how I'm going to treat your income because you're both self-employed. But if your spouse, by the way, what if you guys co-own the business and one of you has bad credit and I'm only using the income, I'm only using one of you on the loan? I actually can only count half of your business profit. Think about that for a second. Your business says you are co-owners, then you're 50-50. And that means that your profit on the business is a certain dollar amount. Now, this is if you have it as a partnership. If you have it co-owned where you're literally both full owners, if it's a sole proprietorship and it has both your names on it, that's no big deal. But if you're literally a partnership or if it's a corporation and on the S corp or the C corp it says you own 50% and she owns 50% or he owns 50%, then if one of you is not on the loan, I have to ignore the 50% that that person owns. So be keenly aware. Why would we leave somebody off the loan? Because maybe their credit isn't very good. Maybe they have some other issues. Maybe they own a lot of other property and their debt to income ratio is out of line. We cannot use that person's half of the company income if they're not on the loan. If your spouse is an employee of your business, I treat your spouse like an employee. I talked way at the beginning, 35 minutes ago, about why it's easier to qualify employees. Your spouse is an employee of your business. Sometimes there are extra rules for a family owned business, but those rules are not as big as they used to be. So in most situations, if you gave your spouse a raise from $4,000 a month to $5,000 a month, as long as I can justify why and it's reasonable, then we can use the higher income. I don't need a history of it. Now, if you gave your spouse a raise from $4,000 a month to $40,000 a month, that's not reasonable. We're going to know that you're just trying to qualify based on throwing more income than is reasonable for the job title. So just be aware that there are some challenges with it, but in general, we can use your spouse's income if they're working for your business, just like if they were an employee. Okay, so I kind of covered this. I'm gonna move quick through this one. If I'm an employee of my corporation, can you just treat me as an employee and can I just give myself a pay raise? I covered this earlier. The answer is no, because I'm going to use what your pay was plus your profit is your total earnings. And if you gave yourself a pay raise, That doesn't guarantee that your business is producing that much more in income. And if your business produces the same revenue and the same expenses this year as it did last year, then your pay raise just means more expenses and less profit. But the total between your pay and the profit that's left over won't change. So giving yourself a pay raise does not make us qualify you for a higher dollar amount. All right, a couple other things I want to cover, miscellaneous stuff. What if I want to run my business out of my house? Good for you, no problem at all. You actually get some significant benefits of writing off your business use of home as an expense. Just be careful because different loan programs look at that differently. Some loan programs take the logical approach that says, hey, paying a mortgage payment and I'm subtracting a portion of my mortgage payment out of my income from my business because I'm using that for business purposes. So we should be able to just ignore that expense because you're already hitting me for the mortgage expense. You don't need to count it again as an expense against my business. Some loan programs allow that. Other loan programs say, nope, we're not going to let you ignore the business use of home and we're going to count that against you as well. So just be aware that if you're running your business out of your home, we have to talk about what type of loan that you're doing and whether that is going to be an expense that's going to hurt you or neutral and is not going to matter to you at all. Again, guys, quick reminder, post some comments down below. I'll jump in there and answer them as we move on. Can I amend my tax returns to qualify for a higher price? I covered this as well, but brief recap, no. We believe whatever you said the first time. So before you file your taxes, send a preview copy to me so that I can review them for you and help you understand what the implications will be on your qualifications, especially in the rising rate environment that we're in. Interest rates have moved almost 2% in the last 90 days. Like we were theoretically in the high twos at the end of last year. We are squarely in the mid to high fours right now. And honestly, with inflation the way that it is going, interest rates are continuing to move up. So if you were thinking of buying a home anytime in the next couple of years, now is a great time to do it. If you're worried about where housing prices are going to go onto my YouTube page. I'll have my YouTube banner on the bottom right here in a second. And my YouTube page is youtube.com/ John Lone King. I have a video on there called The Future of House Prices. And it's a pretty short, I don't know, 5, 8, 10-minute video, much shorter than this one, but it talks about the future of housing prices and what I think is going to happen. Spoiler alert, I think housing prices are going to stay strong through at least 2025. So if you are thinking of buying a home in the next couple of years, now is a great time to do it and doing it before interest rates go up any higher. So if you don't amend your tax returns, that won't help, but show me your taxes before you file them. Are there ways to avoid using tax returns or bank statements in qualification? There is. If you're buying an investment property, I have a program that or refinancing an investment property. I have a program that allows me to use the income from the investment property to qualify you. I do not have to see your tax returns. I don't even look at your other debts or your mortgage payment on any other homes or anything else. I simply confirm that the rental income from that house is enough to pay for that mortgage payment on that house, and that's it. You got to have good credit, you got to have a good amount of money in the bank, but the truth is it's a great option, but it is a high risk option. So we're talking about interest rates that are probably in the 6, maybe even 7% range. Much cheaper than hard money lending. If you know anything about hard money lending, it's super expensive. Hard money lending can be 10, 12, 15% interest rates. Now, hard money loans don't care about anything. They don't care whether you have any income or a job. They don't care if you have, all they care about is equity in the property. They don't care about your credit. So this program that I have is much cheaper than hard money. I do care about your credit. I do care about how much money you have in the bank. I do care about how much equity you have in the home, but I don't care at all about the amount of income you are producing. So that's a great option if you want to avoid using your tax returns or bank statements in qualification. Quick reminder, by the way, as we look at the banner that's floating down at the bottom right now, every Friday I'm doing this live stream at 12 noon. If you want to get notified and get on the email list for future broadcasts of this live stream, go to rsvpwithjohn.com. Yes, I am John. Go to rsvpwithjohn.com and sign up on the email list for Financial Fridays, and you'll get an email a couple of times a week reminding you of the Financial Friday broadcast and what it is going to be the upcoming week. And you can also find all of our old broadcasts on there as well. This is my second one, so there aren't many old ones to find, but my YouTube library has a bunch of stuff on it that I think you would love. What if I started a new business? How soon can I buy? Well, first of all, if you're using the program I just talked about, where we don't care about anything except the rental income on the property you're buying, assuming that you are buying an investment property, you can do that immediately because I don't care if you have a job. I don't care where any of your income comes from. Otherwise, what you're looking at is typically 2 years from the date that you became self employed. And if we need 2 years of tax returns, I'm going to average the income, and your startup year is usually your hardest one. So sometimes we're going to be better off using bank statements in that case because your startup year was not very good. Your second year was a whole lot better. And we can use bank statements to prove that income because the tax returns may not fully show the income that you're generating now, especially as you get further into the year. If we get into September, October of this year, well, maybe you started in 2020 and 2020 was bad. 2021 was a little bit better, but nowhere near good enough when I have to average 2020 and 2021 together. But once we are, it's October of 2022, and a year's worth of bank statements goes from November of 21 to October of 22, it gives you the most recent 12-month look back. Otherwise, I cannot count any of 2022's income unless we use bank statements. I cannot count any of 2022's income until you file your 2022 taxes in 2023. So bank statements give us a good option to use the most recent 12 months instead of the calendar 12 months. So hopefully that helps a little bit. Can I use business funds for down payment? The answer is yes. The rules used to be more strict. It used to be a bigger deal to use business funds for a down payment. We used to have to get a letter from your CPA confirming that pulling this money out of your business account isn't going to create a major hardship on the business. We, as an industry, have really relaxed the guidelines on that. So as long as you have the money in the business account, we're going to look at a couple of months of business bank statements. So if we're seeing a bunch of overdrafts, we're going to be concerned. But if you don't have a bunch of overdrafts and the money is just floating up and down a little bit, we're going to trust that you know how to run your business and that it's okay for you to pull that money out without negatively impacting your business. Um, Jumbo loans do not follow that same rule. All bets are off on jumbo loans. Jumbo loans require a lot of reserves as well. And so we sometimes can use business accounts for reserves, sometimes we can't. We can sometimes use business account for down payment and closing costs, sometimes we can't. So just be aware that with jumbo loans, everything is different. What if my business was shut down due to COVID? I think I've covered that pretty well in explaining there's different ways for us to prove income. So if your business was shut down due to COVID, then you're going to need to use bank statements to prove your income. Or maybe, if 2021 was a good year, we can hopefully find a way to use only 1 year of tax returns and ignore the 2020 year, because obviously that was the biggest impacted year of COVID. But 2021 wasn't that much better for a lot of business owners, especially restaurateurs. So that's a huge challenge if you were in one of those severely impacted industries, because even though we know COVID was hopefully a one-time occurrence, and we could theoretically argue, any of us could argue, what are the chances of all those circumstances coming together again for 2020 and 2021 to repeat in the future? Hopefully slim to none. But our mandate from the federal government requires we look at the last 2 years and assume the last 2 years are the indicator of what the future is going to be. And we cannot ignore calamities. We can't ignore major shifts in the market that happened during that last 2 year time frame. The only things we can't ignore is if you're out on disability and we've got documented time of disability, we can sometimes ignore that, but that's even pretty hard to do when you are self-employed. Quick reminder, guys, we're going to be wrapping up here soon. So if you have questions or comments, please post them in comments. If you like this, if you like the information that I provided, please click the thumbs up button on whatever platform that you're on. Please click share to share this information. Make sure to join me on future broadcasts, Financial Friday, every single Friday. I also do a Thursday broadcast for real estate agents, my Business Booster series. You can sign up for both of those by going to rsvpwithjohn.com. SBA loans. COVID, the Paycheck Protection Program, the SBA disaster grant and disaster relief loans created a lot of challenges for us, because if the loan was forgiven, the SBA grant is not a problem because it's a forgiven loan. but the disaster relief loan, the PPP loan, there are components of those that are forgiven, components of those that are not. And if it's not forgiven automatically, then we have to count it against you. The good news is this is less and less of an issue as we get further and further away from the major challenges of COVID that happened in 2020. Thank you to Anita. I appreciate you joining. Hopefully you'll stick around for a couple more minutes as we wrap up, but appreciate that comments. Make sure to like it. Make sure to subscribe. By the way, guys, I learned something new in YouTube, so I'm supposed to say this because I'm now a YouTuber. Is once you subscribe to my YouTube channel, there's a little notification bell that pops up right next to that. Click on the notification button, and that will allow you to get a notification anytime that I am broadcasting live or if I post a new video, and I post them pretty regularly now. So make sure that you not only like my page, but that you push the notification button. So the disaster relief loans, the SBA grants, the Paycheck Protection Program, just be aware that's created some major problems over the last couple of years. As we get further and further away from those being a major component of finances for companies, then it's becoming easier and easier. But the problem is the the industry takes the worst of both worlds. And they say we have to pretend that whatever happened over the last 2 years is going to continue, but we also have to take any help that you got during that time and call it temporary because we can't guarantee that will continue. That kind of sucks. We guarantee the bad stuff will continue, but the good parts that the government stepped in to help you out, we can't guarantee are going to continue. So I can't count those on your benefit. The same holds true with temporary unemployment. Now, there's seasonal unemployment. Now, this isn't necessarily true for business owners, although it could be. Well, not really. But for employees, if you were temporarily unemployed, you lost your job because of COVID, I can't count that unemployment time. I can't count the income you got from unemployment. But if you were seasonally unemployed, if you work a job, if you are in construction and you're only working when you're outdoors and you're paving roads and during the winter when it's raining, which it didn't rain much this year, but during the winter when it's raining, you don't work, then you get seasonal unemployment. I can count that unemployment because it's expected that, hey, it's going to rain every year. Or if you're working in the fields and you're doing something related to the harvesting of crops or pruning or whatever, then we know that every year there's going to be a season for harvest and there's going to be a season that you're not harvesting and you're making unemployment. So we can count that because it's predicted to continue. But a PPP loan, that isn't predicted to continue. So even though your revenue went down in 2020, and I've got to assume that lower profit is going to continue, the money the government threw at you to make up for it, I can't count to continue. So it creates a major problem with how we look at taxes. Again, it's becoming less and less of an issue as we move forward. All right, gang, that is the end of what I needed to cover. So first of all, for those of you who are on here right now, I would love for you to give me just a quick comment, say hi so I know who's here. And also, obviously, that is self-fulfilling because the more comments you make, the better I look to YouTube and to Facebook. So give me a comment, say hi, tell me what your favorite thing was about today's broadcast. If you learned something, please tell me what you learned. If you've got a takeaway from it, I'd love to hear what your takeaway is. And if you're watching this after it was live, just post your comments, tell me what your takeaways are. I'd love to get some feedback from you. I'm also looking for ideas for future Financial Fridays. So if you've got a topic, something that you don't understand, something you think I should share, please, please, please tell me what that is. Post it in comments. I'd love to hear. So my next two webinars, my live series, again, every Thursday, I'm doing my Business Booster series for real estate agents and industry professionals, and it's going to be tips for writing the winning offer. Okay. If you're a home buyer and you're in the process of buying a home right now, feel free to join. You don't have to be a realtor. It's designed for realtors, but I'm really teaching realtors ideas and we're sharing ideas that will help you to qualify or to get qualified, not just qualified, help you to win when you write an offer. Penny said, let's see if I can get Penny's comment up here. Penny said, I like the income property and using the income to qualify. That is great, Penny. So if you're in a situation where you can't qualify, we don't want to use your tax returns. We absolutely can use the property from the income to qualify without caring about your taxes or any of your other debts. So thank you so much for that, Penny. Again, anybody else who has any things that they liked or any comments, please feel free to post them. Next Friday, I'm talking about first-time home buyer tips. So we're going to talk about how to be successful in being a first-time home buyer in today's market. It is a seller's market. Even with interest rates going up, you still have a lot of competition from a lot of other buyers. And I'm going to give you everything I've got to help you succeed in today's market. So if you have any questions about any of these things, please register to join me, rsvpwithjohn.com. Otherwise, guys, I really appreciate you joining me today. Please like and share this with anybody and everybody that you know. And I look forward to continuing to be a resource and to touch base with you guys every single Friday for my Financial Fridays and to help you to build wealth through home ownership. Thanks, everybody. Hope you have an absolutely wonderful day, and we'll talk to you next week. Bye bye.